Folks, T-Buzz here. There's a high degree of risk involved in trading, and past performance is not indicative of future results. Now, first, if you know anybody that wants to get quality education totally free, tell them to go to our YouTube channel at TBuzzTNT. Click the bell to get notifications when I go live. I'm starting to go live a lot more, and you'll be notified when those moments come. We also have customer service live at DTI that is open from Monday to Friday, 10 o'clock to 1 o'clock. All you have to do is sign on to www.dtitrader.com/help. If you see a subject here you got some questions about, go there. They will answer the questions. In my opinion, one of the biggest problems most people have is when they make trades, they don't know what to do when they go bad. So you got to think it out. I have a lot of techniques that I use. This is one of many, but I want to share it with you today. How to handle trades that go bad. Everyone loves the idea of trading the QQQ, one of my favorite indexes to trade, especially when it comes to day trading. But we all know trading is not easy. Regardless of your experience level, you will have losing trades. Let's talk about what to do when the trades go bad. Now, proprietary choice number one. I use about 30% of what I pay as a punting price. In other words, a price to exiting out a loss. So if I pay $1, around 70, I'm going to be thinking about getting out of that trade or that particular option. Now, when to use this strategy, if I get in a trade and it reverses and I believe my original analysis is going to happen or not going to happen, it's completely wrong, I'm going to take a loss. Choice number two, if I believe my original analysis is correct, but my timing is off, what I will typically do is turn the trade into a spread, as long as I have enough time to expiration. Enough time to expiration for me is 8 days or longer. And example, if I have $1 option I pay for and it goes to 70 cents, I'll find a higher strike call and sell for 30 cents to put it back into play, which restores the trade. Turn it into a spread and let the trend take care of me, maybe not today, but over the next few days. Remember, I will only do this if I think the eventual trend will continue higher. It also mitigates sometimes when you have some bad timing when you get in. Turning the trade into a spread will lower my total exposure in the trade. In other words, this buys me more time for my initial analysis to work out. This is also a method of avoiding a day trade. Whether you want to take a profit or take a loss, to avoid a day trade, you can spread the trade, usually at the end of the day, exit both positions the next day. This technique will help you, and the DTI method will help you determine whether a trade gone bad is a real loser or maybe just needs a little bit more time to work out. Key insights. A strong stock in a bullish trend will have down days, even down weeks or even months. We can use key opening prices to determine how severe a pullback is. Key opens to track. Month open, for every month you get a new one. Every week you get a new one for the week open and the daily open. Now inside the day, there's what I call reference bars. This is a proprietary technique we've been using for years at DTI. Strong stocks that pull back tend to find support at the week open and the month open. A clear break of these key opens a sign of further correction is likely. So when trading options, it may be necessary to look short term since options have an expiration. At DTI, we use this proprietary technique and process we call reference bars. Reference bars are 30-minute bars placed at key times throughout a 24-hour market. Typically, we place our reference bars at times when key markets around the world are opening or closing for the day's session. Let's go through the DTI reference bar times. The first one kicks off in the evening in Asia from 6 to 6:30 Eastern Time. That sort of sets the tone for Asia, watching that range. In the middle of the night, probably when most people are sleeping here in America, from 4:30 to 5, you have your second reference bar. We call that RB2, and that sets the tone for early trading. Then, of course, at 7 o'clock and 7:30, that's when most cash markets are accessible. 7 a.m. to 7:30, they call it the pre-market. We look at that bar. And then finally, the day opens, the cash open from 9:30 to 10. We call that RB3. Now, another reference bar that seems to really work well if you're aware of it is when Europe closes, and that happens between 11:30 and 12 Eastern Time. We call that reference bar RBY. And then finally for the day, we have RB4, happens at 1:30 to 2. And then when we have the closing bell trade is set up by the 3:30 to 4 o'clock Eastern bar. So if you follow these reference bars from start to finish, you will stay in sync with the short-term trends that develop over the course of that day. Now, reminder, I only stay in a trade and hedge if I still believe it will go higher and I have enough time to expiration. However, if my initial analysis is wrong and the stock is reversed and I don't have enough time left until expiration, I'll just exit the trade and move on. Understanding the strategies we use with options will help you turn losing trades into smaller losses, break-even trades, or even wins if you do it right. And as I always say, see you on the flip side.